Imagine this. You're paying for your dream house. Everything feels stable. And suddenly one day, the bank takes it away. Your savings? Gone. Your job? At risk. Now imagine this didn't happen to just you, but to millions of people around the world. So what really caused the 2008 financial crisis? And the bigger question, could it happen again? The beginning. To understand this, we need to go back a few years before 2008. At that time, getting a home loan in the US became extremely easy. Banks were giving loans to almost anyone, even people who didn't have stable income. Why? Because everyone believed one simple idea: house prices always go up. So even if someone couldn't afford payments, they thought they could just sell the house later at a higher price. Sounds safe, right? That belief was the first mistake, the bubble. As more people started buying houses, prices kept rising. And when prices rise, more people rush in. Even investors jumped in. Not to live, but to make quick profit. This created what we call a housing bubble. But here's the problem. This growth was not real. It was built on debt and false confidence. Now here's the part most people don't know. Banks didn't just give loans and wait. They did something smarter and more dangerous. They took thousands of these loans, mixed them together, and turned them into financial products. Then they sold them to investors all over the world, calling them safe investments. So now, risk wasn't just in one place. It was spread across the entire global system. Even worse, many of these loans were given to risky borrowers, but still, they were rated as safe. This is where the system became fragile. Then reality hit. Around 2006 to 2007, house prices stopped rising. And when that happened, people who took risky loans couldn't repay anymore. They started defaulting. Banks began taking houses back, but now those houses were worth less. So losses started building fast. And because these loans were sold worldwide, the damage spread everywhere. Now comes the moment that shocked the world. Huge financial institutions started failing. The biggest example, Lehman Brothers. When it collapsed in 2008, panic exploded. Banks stopped trusting each other. Loans stopped. Businesses couldn't operate. And just like that, the entire financial system started freezing. But this wasn't just about banks or numbers. This was about real people. Millions lost their jobs. Families lost their homes. Savings disappeared. Imagine working your whole life, and suddenly everything is gone. In the US alone, millions became unemployed, and global economies suffered massive losses. This crisis didn't just break markets. It broke trust. To stop the collapse, governments stepped in. They gave huge bailout packages to banks. They lowered interest rates. They pumped money into the system. The goal was simple: stop the system from completely crashing. And slowly, the economy started recovering. So what actually caused this crisis? Not just one thing. It was a mix of easy money, risky lending, greed, and a system that ignored warning signs. The scary part? Many of these patterns still exist today. So now I want to ask you something. Do you think we learned from 2008? Or are we slowly building the next crisis again?